And as you just saw at the bottom of your screen, Yahoo, the shares are actually up marginally, up by 0.3%, based on this news that we have been hearing about for several weeks. Dom, just hang out for me for one moment, or hang on for one moment, because I want to bring in an analyst on Yahoo. He's joining us from Florida, benchmark analyst Clay Moran. Clay, thanks so much for joining us. And, why do you think the stock is reacting to this? Was all of this priced into Yahoo?
Well, the reaction is very modest. It's up a dime right now. This has been much anticipated. So stock's doing better than the market, but it really isn't much reaction, I think, as people had expected this to be announced.
Right, they had expected it, and perhaps it was priced in already into the stock price. And as Dom was reading through that statement, Clay, that they're going to be revealing more, or talking more about their strategy on April 17th when they do release their earnings, what do you think they've got to say? What do they have to say that day?
Well, hopefully we'll get some clarity around where they plan to focus their efforts and what type of changes they're going to implement to try to restart revenue growth. Clearly, I would think they will focus on their content properties. That's their strength, and try to enhance their display advertising business. But I think that most people believe there is some significant change required here to really get the company going again. So whether that's something commerce-related or maybe a greater push into online video, it's not clear yet, but that's what we'll be looking for.
Well, are these layoffs, these job cuts, significant, Clay?
Yes, they are significant. It's 14% of the workforce, so that's a major reduction in force. There are significant cost savings, but I don't think that changes the opportunity of the company. You really can't cut your way to revenue growth. So we're going to wait. I think the investment community is waiting to hear what the strategy is going forward, as opposed to how many people they're laying off. That's not really a strategy for growth.
Well, Clay, let's talk about that really quickly here, because we're talking about, of course, mounting competition from the likes of Facebooks, the Googles, everybody else out there who's got a real foothold or trying to get one in social networking. It's not just about the web search part anymore. What exactly can Yahoo do on the other side, not just the cost-cutting side, to strategically place themselves for more upside in the stock, Clay?
Yes, well, I think the strategy that they should implement is a big push into online video. If you look at the online world today, the major categories are dominated by one player typically. Search is Google, social is Facebook, commerce is Amazon. And even mobile is dominated by two players, Apple and Google. The area that's somewhat fragmented, that has significant growth potential, is online video. And it's a perfect fit for Yahoo because that's a premium content website to begin with. So they could marry those two things, their tradition as a content property and the emergence of online video, and create a compelling video strategy.
But what is going to, Clay, in your view, what is going to get the stock price moving?
Probably the only thing in the near term that could really get it moving is something around the Asian assets, something having nothing to do with layoffs or the operating strategy, because even when they articulate the strategy, it'll take months, if not years, to see whether it's successful or not. But in Asia, where they have significant passive investments, if they were to, quote-unquote, unlock that value by selling those investments, they could create a real catalyst for the stock.
Okay, Clay, thank you. Clay Moran, a benchmark analyst for Yahoo. Now, still ahead, Ed to Dom.